Tim Quast, founder and CEO of Market Structure Edge, joining us now. Tim, how was your weekend?
Spencer, what I despise. Can you hear me all right?
Yeah, we hear you.
Is it good? Okay, good. What I despise is when the weekend comes along and interrupts my work. That's just really frustrating.
Tough life, Tim.
He doesn't like the
well,
weekends.
thank you. Good to see you guys. Happy Monday to you.
Tough life. All right, so let's start with this. We haven't really talked about like all the crazy action that happened on Friday's close yet, between the options expiration, between the Nasdaq rebalance. I want to get your high level thoughts on how that played out and how all of last week played out, because you were actually spot on the money with calling for volatility here. So I would like your take on last week, and then we can look forward to this week.
Thank you. So I appreciate you mentioning that. Yeah, I expected that the market would be down Monday and Tuesday. This is what happens into an expirations week. And then everybody talks about the wrong stuff. Oh, it's Omicron. It's this thing. It's that thing. Then the market zooms, heading into the index options expirations. So you get a good Wednesday. Then you find out where money is when things reset with options expirations. So Thursday was index options expirations, and it's our only European style instrument in the US market. And that's a date certain instrument. The rest of them, and you guys know this who trade options, the rest of them can be used at any time. So that's the only one that trades at a set point. So it gives you a very good read on international money in US stocks, and the market was down. So you have some cut to exposure to US equities. Then on Friday, you have this, crazy volatility. And I went out on a limb and said, well, the Nasdaq could actually close up. It didn't, but it was close. And it tells you really what happened. I noted this in my note to you, Spencer, that it had the largest behavioral volatility of 2021, which means there was more movement in all the pieces than any other day of the year so far. In fact, you have to go back to December 28th last year to find something similar. So traders, let me explain that to you. What that means is the stock market isn't just doing what you hear on CNBC, reacting to Omicron, or it's now the reopen trade, or it's the work from home trade. That's not how the market works. There are the machines that set prices. There are trades tied to derivatives. There are trillions of dollars of those. There's passive money. That's the stuff that's going on. And it reset on Friday. And the biggest thing to me was that there was a colossal drop in demand from passive money. And if that doesn't improve over the next number of days, we're going to be in trouble. And I told the Edge subscribers today in the Market Desk note, I said, okay, so today, new options trade. And so this will be a great read. If people come back and renew their derivatives positions at better, lower prices, we're going to be in great shape. If they don't, we're going to get pounded. And the futures don't necessarily mean what will happen. We are going to see how that unfolds. But that's your read on what's going on. I think those things are so important. I talk about this all the time to Edge subscribers. It's one of the big things that you have to be aware of. You're taking big chances when you trade during options expirations because you never know what's going to happen.
It's a fantastic point you're making, Tim, and we see this play out again and again on the Mondays following a big expiration, because I always talk about like the release, where you have the options, the pinning, that's all pressure, and all of a sudden all of a sudden you lose the liquidity from all those options expiring, and then you actually have a big move in one direction or the other the following Monday, and everybody sometimes is like, what happened? But the liquidity is not there. So it's kind of like the perfect storm we had over the weekend here, where we lose the liquidity from those options expiring on obviously on options expiration Friday, and now you have the bad headlines where Omicron's obviously spreading with some sporting events going down, so you start seeing that go down, people wanting to get out, and the liquidity isn't as strong as it would have been, last week, because those options are off the board. So it makes for an interesting, trading, and makes for more volatile trading here. What are your thoughts? What's the market structure saying now? I mean, now, you came on last week. You're absolutely correct to be cautious. Are you still remaining cautious here? Or is there anything that gives us a glimmer of hope that Santa Claus might still come to town?
Well, you never know. The math says that the probability of additional gains has diminished, and I'll show you what I mean by that. So in times like those, we tell folks who use Edge that you want to be in, well, I call them fives. You want to be in fives where the supply is limited. That's the stuff you want to be in when the market is uncertain, because it's most likely to either preserve your cash or give you maybe a little return on it. And you want to avoid the things that are going to be volatile. And it's very apparent in the supply-demand balance. So let me show you here. And I'm going to break a little news as well, because we
like breaking news. Give us wait.
Get Spencer. Come on, Spencer.
All right. What do we got?
So we have some new stuff that we are testing on Edge. So I can give you both here. I can answer your question, Dennis, and break this news at the same time.
I like that.
So here's broad market sentiment at 6.8. You can run the math on this. We can anyway. Internally, we will go say, well, what are say back to 2017? So go back to 2017 and run the data forward. What are the cumulative gains in the stock market when broad sentiment is 6.8? A negative 1.6%. So it tells us that the probability of that doesn't mean it doesn't happen. It just means that if you add all the times up, you're likely to lose money rather than make it. So if you want the gains in the market, you want to own it when it's above 5. Almost 98% of the gains in the market come when the market is above 5 and rising. When it peaks and begins to fall, you want to leave. So these maths say that's not great. There can be exceptions, and those would occur during year-end window dressing. I'm going to show you one thing, but here's what you can do. So here's the breaking news. So we've added these capabilities, and if you want to try this, go to marketstructureedge.com. We haven't released them, but we will this week. So I'm testing them. So here's what you should own. In times like this, when you have no idea which way the market's going to go, what you want to do is say, let's go to fives that have been there for 30 days. So that's what I'm doing. I'm saying, let's go find stocks that are at 5 out on a 10-point scale for at least 30 days, and where short volume is less than the market. So we're going to say less than 45%. Believe it or not, the S&P 500 is 45% short, but that's the supply line. It's the supply chain. Okay, so now if we filter for that, here's the kind of stuff that you want to own. You want to own, like EQ, AMH, American Homes for Rent. Look at that. So the supply side is basically dead level below 40, and the demand side is dead level. So what's the stock do? Well, it hangs right around. You can actually get some gains in that. Same with EQR, Equity Residential. Great Sam Zell company. So once again, here you have a supply side that's very level, starting to trend up. So maybe there aren't many gains left there, but it's a 5. So that's the stuff you want to own. You don't want to own look, we could look at SunPower. Why would you be very cautious about SunPower right now? Well, look at the supply-demand balance. The supply-demand balance in SunPower is the opposite of what you want. So it's on the floor, but the supply side's still rising. So when you have rising supply and no demand, prices fall. You want to have the opposite condition. So what's the broad market going to do? Unless this passive money comes back this week. We have new options trading today. Counterparties true up their books tomorrow. Wednesday are VIX expirations. Thursday's reality, and Friday the market's closed. It is a messy week, but we'll see. If we get passive money coming back, maybe we're okay, Dennis.
Tim, what about this idea that flows follow performance? We were talking about last week, I think it was Thursday or Friday. I brought up a chart of the flows into the ARC funds and how they peaked in December of last year, the inflows. I've gotten this idea that obviously anyone who follows, the fund flows knows that it's been a record year for inflows into U.S. stock funds. That means mostly ETFs, but also some mutual funds, right? Yeah. Yep. So it's already been a record year, and the year's not over, right? In terms of amount of money that has flown into U.S. stock ETFs. What about this idea that like that money is just chasing the past performance, and that, granted, this is not the first record. This is like the third or fourth year in a row that we've had a record, it seems like. But
Right.
what about this idea that like all these inflows is just another sign of people chasing past performance, and a maybe potentially a topping indicator?
Well, certainly the answer to your first question is this: people chasing past performance. Of course, it's the it's the oldest pursuit in the capital markets, that you chase past performance. Whether it's an indication of a top or not, I would say it reflects the surfeit of money that exists on the planet. There is the fact that you have central banks. This is monetary policy, so I'm not going to bog down in it because it clears a room, right? It clears a room.
Thank you.
But that money will coalesce around capital markets. So if it doesn't help the poor, it flows to the people who can deploy it. And so that, to me, is what it reflects. The risk, if you want, you want to talk about the risks in this, what ETFs do is expand access to the same stuff. They don't create more stuff. It's not like an IPO where a company issues stock and now we have more product to consume. ETFs depend on the same underlying stocks that everybody else does. They just enable money to track alongside that same stuff. And they create an almost infinite capacity for money to have exposure to those assets. Well, the problem with that is, what if it stops? It goes back, one of my favorite phrases. I've used it over and over on Benzinga PreMarket Prep. Herb Stein's law. Stein's law, Ben Stein's dad, Herb Stein, an economist. He said, if something cannot last forever, it will stop. It's a funny line, but the problem is what happens to us when that stops. I think it is a big risk. It's why other than to trade them, I avoid ETFs. They're derivatives, and they do a great job of increasing exposure to the equity market. But when it comes time for things to contract, it's going to create risk, no question.
Okay, that's about as good as answer, I think, as one can give, because obviously no one knows the future here. But I've got this idea in my head now that I don't know, $1 trillion of inflows is what we've had this year into specifically United States stock funds. That's not all funds. That's just ETFs that give exposure to the U.S. stock market. And $1 trillion is just, it's a lot of money, man. I don't know. It just seems like all those inflows have to be a sign of something. But maybe it's not a sign. Maybe I'm just looking for a sign. I don't know. But
so Tim, I just got one thing for Tim here.
Okay.
So we had the unwind, right? We had the quad witch, and I always look for these to be, turning points in the market, whether continuation of trend or a key reversal here. So going a little bit shorter term, I know this is a synthetic Tuesday here. What you'd be looking for is, we better get our footing in the next couple days, right? Or else you're looking for another major leg lower. Is that would that be a safe assumption?
Yes, it would be, because of this. And if I don't forget, let's take a look at FANGs, because the supply demand balance in the FANGs is crucial. It's crucial to the support of the market.
No doubt.
Here is a 30-day view of broad market sentiment. Again, this is a compilation of the 500 stocks comprising the S&P 500 averaged, and then compared to SPY as our price proxy. So here's SPY, and it's been very volatile. And sentiment was only volatile back here. It really hasn't been volatile. It bottomed here, and the market moved faster than sentiment. And will it again? It's possible. But this is a top. Generally a top will give us a signal of a coming downturn. The question is, will we have a recovery, because some of this money comes back and then the market falls apart? I'm not saying that's going to happen. I realize that there are all kinds of pundits. The guy from JP Morgan, Kolonovich, I think he's a very bright fella. He thinks we're going to get a short squeeze. There are multiple parties who are expecting a big move to finish the year. And maybe it happens. But almost never does the market go higher when sentiment is 6.8. Mathematically, I can look back over the entire data set, and it's very rare. Now, it doesn't mean it can't happen.
Why is sentiment so high right now on your indicators? Because you look at other indicators out there, and sentiment's very low right now. So it's just like I find that interesting that your sentiment indicators are different than what else is out there. I'm just curious.
Yep, they are, because ours is the only market structure sentiment reading in the market. Everybody else uses something else, and our measure is impervious to price. It is really all about the movement of behavior and how those affect price, yes. But we're not metering price to determine sentiment. We're metering the rolling change in the market. So if the rolling change in the market, this was heavily derivatives driven. We say that when the market recovers faster than sentiment, it is evidence of a lot of leverage using derivatives. Now, did that work? I don't know. Did people make money, or is this another March 2021 where Archegos Capital blew up? It's possible. I'm not saying it is. I'm saying there is some evidence that could be a risk. But that's why our reading is different, Dennis. We're going to calibrate the movement of people chasing story, people chasing characteristics, people chasing price, and people chasing derivatives, and how those things move in comparison to each other. And the biggest one is price. That's 54% of all market volume. And so that's a very short-term event. So if the rest of the stuff goes down and that goes up, we can get a very strong movement in sentiment, but it is not sustainable. So we'll see.
All right. Tim Quast is the founder of Market Structure Heads. Yeah.
One last thing I want to share this with you, because
all right.
I think this is important. FANGs. The FANGs are the engine of the market. And here's why the market has struggled. Look at the FANG supply and demand balance. Here's demand. It just barely got back to 5, and then it turned down. And the supply side has been above the trend. But here's the good news. And I think this is Joel, this is the rest of the answer to your question.
Okay.
If the supply side continues to trend down and the FANGs recover, we're going to be okay. And that is possible. I look at the FANGs and say, that ain't bad. So that's our ace in the hole, and we better hope it gets played.
All right. Tim Quast is the founder of Market Structure Edge. Link in description. Tim, always a pleasure. Have a good one.
Back at you guys.